Hi, everyone. David Rose here. Welcome to the next episode of the Scaling Stateside podcast. Along with my co-founder and co-host, Matt Oxley, we're on a mission to help UK and EU founders successfully enter the US market. And of course, a big part of that is venture fundraising. So we're also trying to talk about venture fundraising best practices and help them understand the overall market. So as part of that, we have a very special guest with us and good friend, Dan Glazer from Wilson Sonsini. Dan, please introduce yourself for those of people who don't yet know you, which is probably a pretty small number, and tell us where in the world you are today.
Sure thing. David, Matt, great to see you, and thanks for having me on today. So my name's Dan Glazer. I head up the London office and the U.S. expansion team at the Silicon Valley headquartered law firm Wilson Sonsini. I am usually based in London, but actually traveling today on business in the great city of Manchester. So looking forward to speaking with you today.
Great. Well, I think one of the things that's really important about your relationship personally with startups and also Wilson Sonsini at a high level is you collect a lot of data. You close a lot of deals with the venture capital community, specifically in the U.S. And as part of that, Wilson Sonsini collates this data and publishes an entrepreneur's report, kind of a macro look at the venture fundraising trends that I always thought as a founder I really wanted to be aware of, so I can always help position my company and my pitch just a little bit better to kind of fit the market and what the market's looking at. So just at a high level, Dan, walk us through, and again, there's probably a bunch of ranges. Let's think about a round kind of range for today's discussion. Talk us through kind of the reporting from the WSGR Entrepreneurs Report. Again, this is backward looking to 2025, but it's probably going to shape the trends for 2026. Give us a high level as far as what you're seeing for valuations and fundraising amounts and those sort of things.
Yeah. I mean, generally speaking, I think that this is certainly what we're seeing with U.S. investors where they're investing in the United States or overseas into the UK and Europe. I mean, it's overall a very robust time, right? I mean, we're not quite in 2020 or 2021. But the sort of slight down cycles that we saw, let's say in 22, 23, 24, we're past that. And yeah, part of that is AI, but not all of it. And I think generally speaking, if you think of venture capital and especially let's say Series A as being maybe a series of peaks and valleys that tend to level off and look a little bit smoother, in the aggregate. We're on if not a current peak, certainly near a peak. It's all in all, especially if you're an AI company, a pretty good time to be raising capital in terms of the availability of capital and the size of rounds. I mean, to just look at the reporting on a day-to-day basis and the size of rounds that we're seeing certainly reminds me a bit of the sort of thing that we saw in the early 2020s.
So Dan, looking at the macro trend reports, I think a lot of founders in the U.S. are pretty comfortable with the market being dilution at 20 to 30%. I think a lot of times founders we talk to in Europe might come with a different number, and I'm always pitching like, "Hey, sell people what they want to buy. Don't get cute and come with an unusual number." What do you see as kind of the trend overall dilution at the A round level? What should a founder expect?
Yeah, so. One of the things, and this is going to be a theme I think that we probably come back to between the U.S. on the one hand and the UK and Europe on the other, is that there's a little bit less, let's say, homogeneity in the UK and Europe, especially at the early stages of fundraising, than there is in the United States. Now, it's interesting. You might think that I say that. I'm like, well, there's because there's so many different funds in the U.S. in terms of stage, in terms of sector, in terms of investment thesis. But there actually is relative standardization at the early stage in terms of what they are looking for, right? That they are looking for fairly fast moving businesses that can reach venture scale outcomes and generally investing according to so-called NVCA, National Venture Capital Association norms. And within those parameters, there actually is a reasonable amount of standardization. And as you said, that kind of 20% give or take dilution is pretty common. In the UK and Europe, there's a whole range of different investment styles. Certainly at the early stage, it's seed and Series A, that could be looked at as venture capital, right? Like on the one hand, and I'm just going to think of it as maybe a bit of a risk spectrum, right? You've got, let's say, American funds with offices in the UK and Europe who are taking this sort of same approach to things as they would in the United States. Then you've got funds that are UK and European based, but may take an American style approach to risk and things like dilution and terms and all of that. And then you've got other funds that might be driven by, let's say, tax dynamics, right? Like in the UK, when you've got things like VCT and EIS and SEIS, and they may be looking at the world both from, hey, can this company give us a venture scale return, but also what are the tax implications involved, right? And that adds maybe another angle to it. And then you've got still other funds that might be taking a little bit more of a private equity style approach, but they'll be dropping down and doing venture stage investments, right? And you've got one end of the spectrum that might be looking at the world as, well, okay, for every 10 investments, 7 are going to fail, 2 are going to wash their face, and 1's going to return the fund or more, and we're going to bet pretty aggressively. Whereas on the other end of the spectrum, more private equity style, there may be more of a focus on minimizing downside risk, right? That may be limiting massive upside potential, but that may be fine. That's just a different investment style that they're bringing to the table. And the reason I bring that up is because that may impact how the company and the investor ends up thinking about dilution, right? Like if you're taking more of a downside risk minimization approach, you might end up taking, let's say, a larger portion of the company, right? Than you might if you were taking, much more of a high risk approach. Right. And what might be appropriate, more of a private equity style venture stage transaction when it comes to dilution, is not necessarily going to be what's appropriate. Let's say for a classic Silicon Valley shoot for the moon kind of round. And neither side is right or wrong, but what I do think gets maybe glossed over a bit in the UK and Europe is that what is referred to as venture capital in the UK and Europe, especially at the early stage, is covering over a much broader range of investment styles and approaches to thinking about risk than in the United States, which is a little bit more homogenous.
That's great. And just a further question on deal structure and terms, because one of the things that we're obviously trying to do in scaling stateside is, educate and inform people as they're going through the process. And I certainly, when I was raising money in the US, it was foreign to me. So one of the things I just wanted to pick up on was founder revesting and the requirements that potentially are there from a Series A stage. And when should a UK EU founder push back on this? Versus when is it accepted? How typical is it? Because this is something that came up in my fundraising. So again, it's about educating and passing on that knowledge to others. So what would you say about that?
Yeah, I mean, even in US term sheets, right? It's actually pretty common at the Series A stage to ensure that the founders remain incentivized to stay at the company and keep building. So, so seeing revesting requirements, even in U.S. term sheets at Series A stage, it's not particularly unusual. Now, and depending on the leverage that the founders may have, you want to consider whether or not, vesting starts immediately, so-called sort of credit for time served rather than a 1-year cliff, but the concept remains sound. And then you might see full vesting typically over, let's say, three or 4 years. One of the big differences, though, that you might see in the US versus the UK and Europe is that it's a little bit less common in the US to have sort of, to have so-called good lever, bad lever provisions that may make it easier to take away equity, right? Like in the US, it's sort of assumed that everybody is going to be a so-called good lever, that they'll be able to keep what's vested, unless there's like fraud or willful misconduct. Whereas in the UK and Europe, there might be a broader range of outcomes that could lead to maybe losing some equity. And so I think the way I would summarize it is that it's not necessarily particularly uncommon in the U.S. at Series A to have revesting, but the consequences, let's say, are less severe than in sort of the good lever, bad lever environment of the UK and to some extent Europe as well.
Dan, on that same topic, and I always think about these as kind of as a founder, like investor or a founder unfriendly terms. I think, the revesting I'll probably put in that category. And the others that I always think about, and they kind of come and go in trends for whatever reason. But what about what are you seeing from a liquidation preference, ratchet provisions, those kind of things I would call founder unfriendly terms? Where is that in the arc of coming and going at the current state?
Yeah. So we are currently in an environment where it's like one-time non-participating liquidation preference is pretty common. In fact, it's pretty rare to see anything but that outside of down rounds, right? Mm-hmm. And some of the other stuff that you've mentioned as well, ratchets, pay to play, things like that. We're not really seeing that in any meaningful way, certainly in U.S. term sheets, other than maybe somewhat more aggressive down rounds. But we're in an environment right now where we are more generally on an upcycle, right? Like if you go back to say, the aftermath, let's say, of 2020 and 2021, you look at 22 and 23, and I think you saw a little bit more of that when valuations were particularly high relative to historical norms in 20 and 21. There's kind of it went back the other direction in 22 and 23, and you saw more of the types of provisions that you're talking about. But now, in what is, I would say, at worst, kind of a market that feels historically normal, and if anything, is probably a little bit better than normal in terms of being friendly to large rounds and the like. We're not really seeing aggressive provisions like that outside of down rounds, and those down rounds tend to be very company specific issues as opposed to anything that's broader in the ecosystem. I think, again, maybe some of the tougher times in 22 and 23, you could make more generalizations about terms like that across the environment, across the ecosystem. I don't think you can really say that currently.
Yeah, that's great to hear. That's great. I like that trend. One thing, I had a call with a UK founder this morning, and you'll be surprised. He was asking me about, does he need to do a Delaware flip? So let's talk about that for just a second. So what is the expectation at the A round? If you're raising from a US investor, what should the founders be thinking about? Are they going to have to do a Delaware flip and create a US top co? Is that a requirement of closing an A round, or what's the current status of that topic? Because I think there's a lot of expectations or information about that. So set us straight here.
Sure. So let's step back for a second and make sure that we're all talking about the same thing for our audience, right? So what is the Delaware flip, right? And the Delaware flip reflects the fact that in the United States, at least historically, American VCs got most comfortable investing into Delaware corporations for a range of reasons, not the least of which is because Delaware has got tried and tested corporate governance laws, its own dedicated corporate governance courts that VCs in the U.S. For generations know exactly where they stand, from a rights and obligations standpoint, from a corporate governance standpoint when it comes to Delaware corporate law. And, rightly or wrongly, there is a bit of a perception that if a U.S. VC is being asked to invest in a company that is not a Delaware corporation, right, that could be perceived to introduce some friction into the process, right? In other words, at the extreme, you could have a VC look at it and say, look, I feel like I'm taking corporate governance risk here and I don't necessarily see the upside of taking the corporate governance risk. That's what I'm explaining is the mindset typically of investors, why in the US they might prefer the Delaware corporation as the parent company. Because of course, just to go to that parent company point, they're generally not going to invest in a subsidiary. So the money goes into the parent company. And so when we talk about the Delaware flip, the question is, what is the business's parent company, right? And so when a US VC says, I need you to be a Delaware company in order to invest, what they're saying is that we need you to have a Delaware parent over your current UK or other European company. Now, the later stage that the company is, at least what we're seeing in the UK and Europe, is that the less likely it is that a Delaware flip will be required. So at pre-seed or seed, if you're raising a round from a US investor, and let me just be clear about something. When I talk about US investors in this context, I am not referring to the US funds with offices in the UK or Europe. I think if you talk to some of them, they'll give you somewhat of a different perspective on the Delaware flip because they've got offices in the UK and Europe, and to some extent, they've gotten, whether to a greater or lesser extent, they've gotten more comfortable with non-U.S. structures. But from the perspective of the American funds in the United States, if they're leading rounds into UK or European companies at seed or pre-seed, it's not 100%, but it's more likely than not that if they are willing to invest in the business, and that, in other words, the business being the operational and commercial profile, if they're willing to invest in the business, that they may insist on a Delaware corporate structure, that they may insist on a so-called Delaware Flip to put the Delaware company over the UK or European limited company as a condition of the raise. But the later stage that you get, the less likely it is that that flip will be required. So in the UK, for example, when we see US-based VCs leading Series A rounds, it tends to be a minority of rounds. In other words, more often than not, what we've been seeing for a few years now is that if the US VC is willing to lead a raise around into a UK based Series A stage company, that they'll usually do it into the UK limited company more often than not. And then when you get to Series B or later, it's very uncommon in our experience for a Series B or later UK limited company to have to flip into Delaware to raise a US led round. Not completely unheard of, but very uncommon in terms of what market norms are. And I think that just reflects at the later stage the company gets, the more that the US VC is willing to deal with any actual or perceived friction associated with investing into a non-Delaware and especially a UK limited company, because there's no actual legal reason for the most part that a US VC can't invest into let's say a UK parent company. Maybe the one exception is that there are some funds that in their LP documents, there might be a restriction saying that the fund is not permitted to invest outside of the United States, but that's a contractual restriction. That's not sort of any sort of statutory or other legal restriction on investing out of the US. And the later stage that the companies get, the more that the VCs are willing to just take the company as it is from a corporate governance standpoint. And also because there's just the company's less fungible at that stage. There's only so many great Series B and later opportunities. And if it creates friction from the company's standpoint that the VC is requiring a Delaware flip, often those Series B and later companies have other options.
How often do you see in the term sheet, implicitly or implied, that a founder will be required to move to the US when they're raising from a US fund? What is the current situation on that topic?
Yeah, and that's a different point than the Delaware flip, and that really gets to the heart of the question of whether a U.S. VC investor needs the business to be in America versus whether they need the company to be in America. What I mean by that is the business is the operational and commercial profile. In other words, where are the employees? Where does the management team sit? What does the traction look like in the United States? Where are their offices? Where is their HQ? Like actual physical HQ. That's what I mean by the business versus the corporate structure. The company is what is their ultimate parent company, right? What is the entity that will be taking in the capital that is going to be invested by the U.S. investor? So the issue of does the CEO, does the founding team need to move to the U.S. is typically a question of to what extent does the U.S. VC need the business to be in America? And I think what we typically see is if it makes operational sense for management to be in the United States, that will typically be a discussion in connection with the term sheet. Now, will it be built into the term sheet? We've seen it sometimes, but I mean, it can go either way. I don't think that I don't think it would be correct to say that there's a hard statement that every time that the CEO, for example, needs to move to the U.S., it gets put into the term sheet. But it's certainly something that gets talked about in connection with the raise. But what I will say is that the earlier stage that the company is, or the earlier stage that the business is, if they're raising, let's say, a pre-seed or a seed, it's kind of difficult to get those raises led by US VCs without already having an operational profile in the United States. Again, not impossible, but more often than not, what we see are that the European companies that UK and European companies that are successful at getting a US based lead at pre-seed or seed usually are in the process of building a US business already, right? They've got substantial management, or presence in the United States, like the CEO may have already moved to the US or is traveling there so frequently that they may be perceived as being in the US. Or the company's got substantial traction in the United States, or they've got substantial experience in the US previously, right? That's another thing. At this point in the maturity of the UK and European tech ecosystem, there are a lot of founders in the UK and Europe who are serial entrepreneurs who have already built substantial US businesses and now are back in the UK and Europe, such as Matt here, right? And someone with that profile starts to play into the American, venture concept of pattern matching, right? In other words, if you've done it before, and if the VC is looking to bet on team and TAM, quality of the team and size of the total addressable market, well, if your team has got US experience and you say that you're going after the big TAM of the US market, that may be enough to get it over the line at pre-seed or seed.
And then I think one of the things that I learned as a founder is, and you don't really realize it at first, you kind of think, a law firm's a law firm, legal's legal. What I learned over time is just how critical it is that you have someone representing your company in the negotiation process who understands the VC fundraising process and how the negotiations work. So you obviously have been a part of a lot of those negotiations. Just at a high level, what are the typical things you would see a UK or EU founder want to really negotiate hard on from a term perspective that you'd maybe advise them to save their bullets for a later discussion? What are the things they're going too hard on too early? Yeah,
because it also goes the other way too. It's like, what are they not necessarily negotiating enough of? So here's how I want to answer that is I don't think that there is as enough of a widespread recognition in the market about the differences between NVCA and historically what was BVCA, but they've recently rebranded to be UK Private Capital. But for purposes of this discussion, let's refer to it as the BVCA, the British Venture Capital Association norms. That, the model documents or what, even putting aside the model documents, what just the market norms are in the UK and in Europe in the document sets, are fairly different in some respects from what is normal in more standardized US docs. Now, it's easy superficially to look at that and say, oh yeah, well, because one set of documents is contemplating a Delaware corporation, the other set of documents is contemplating a UK limited company, and so it's US law, US state law, right, and UK law. But it's actually much more profound than that, right? If you and this gets to the topics that we either do or don't like see enough negotiation on, which is if you're an American VC that usually invests into US based companies, according to NVCA norms, Delaware Corporation, and you're investing into a UK limited company, right? Is that an English deal or is that an American deal? Right? It's both, right? And should the governing law of the documents be driving the terms that you can get, right? In other words, if the investor usually gives NVCA norms on terms, on things like, whether it be good leaver, bad leaver, or, investor consents or founder warranties or anything like that, where you might see a difference on both sides of the Atlantic. Should that be according to American norms, or should it be according to English norms when the investor is American but the docs are English, right? And I don't think enough founders spend enough time kind of focusing on that, right? And if you just sort of, let's say that you're a UK company, UK limited company, and you end up just taking a standard set of of market norm terms in the UK, but you're getting them from a US VC. You want to think through, well, how do the terms that you have now compare to the other companies in the portfolio, right? If the VC's got, let's say, 10 investments and 9 of them are US based Delaware corporations and you're the only one in the UK, yeah, there are some differences that you should have because you're a UK limited company and just like the requirements of your English law are a little bit different. But other than that, shouldn't the terms be somewhat similar? Right? And that's not something that we see, I think, enough companies really focus on. So interestingly, we're starting to hear this in reverse from UK and European investors. Because I think, as I've noticed this as an American lawyer based in London, is that there's the last maybe couple of years or so, especially maybe the last year, there's been an increasing push for early stage UK and European companies, let's say, to start as Delaware companies at the beginning, right? That they don't do the Delaware Flip, that they just start from first principles as Delaware corporations, and without sort of commenting on whether that's the right or the wrong answer. Like you can see some arguments that if they expect that they're going to raise from early stage US investors, maybe it does make sense to start as a Delaware company. But one of the bits of feedback that we've gotten from some of the UK and European funds is that they find themselves investing into these, pre-seed stage or seed stage Delaware corporations, but the business is completely European based. So the business is, completely based in the UK and Europe. Founders, operations, all of it, based in the UK and Europe. And the companies are negotiating NVCA terms, right? And it's the reverse of what I was just talking about, which is that I've had some UK and European VCs say, well, hold on, why are we giving NVCA terms, right, to companies that, other than the fact that they've got Delaware parent companies, are completely, UK or European businesses? Shouldn't we be giving them terms that are appropriate for the UK and European market? And why does the corporate structure dictate the terms that they're going to get? Interesting point, right? And now that being said, trying to mold, UK and European documents into Delaware corporations is not exactly the most seamless way to structure a venture deal. But to wrap kind of this all up, it highlights the point that we don't see as much negotiation as I think we will going forward, as more and more founding teams, management teams realize the differences out there between what market norms are in the UK and in the US, and whether or not the governing law should be dictating these terms, or whether the market norms of the VC and what their other portfolio companies are getting, whether that should dictate the terms. That's something I think that we're in the early stages of seeing how that's going to play out. But to your question, what should they be negotiating more of or less of? I think having a good working knowledge of the differences between what's market in the US and what's market in the UK and Europe ends up putting the management team in a better negotiating spot.
Dan, that's fascinating. I can certainly relate to that firsthand. One of the things I just want to shift gears on now is to really kind of maybe go through like the preparation and the process side of things. So, and then just kind of thinking about founders going out there, UK, EU founders going out into the US, Series A pitch. What are the common mistakes that you see when they're first engaging with US investors?
Yeah, so I think there's a few different things. One of the biggest ones is not necessarily calibrating correctly for what good looks like to a US based VC, right? And I'll give you an anecdote that sort of tells the story. That a few years ago, I was part of a trade mission to the Bay Area. The Silicon Valley VC came in and he said, and talked to the group, and he said, let me explain to you what the perspective is of a lot of maybe even most of the funds in the Bay Area. He said, we are looking for companies that can return the fund or more. Right? Not will return the fund or more. We can't get the company to promise that, but we would want to see a pathway that if everything breaks right, that there will be, the possibility of getting a fund returner. In other words, the team and the TAM, the quality of the management team and the size of the total addressable market, together maybe with a bit of IP if that's relevant, maybe a good business plan, together with the investors, expertise and their network, and maybe sprinkle a little bit of magic Silicon Valley pixie dust on the whole thing, and maybe just maybe you're going to get yourself a fund returner. And as he said, we will pass on companies that pitch us a more certain but smaller outcome in favor of essentially running science experiments, right? For running, for looking for companies that have the possibility of the big upside, even though it might be less certain. And he said, think about what that means mathematically. Now, at the time, the fund was smaller, and they said, we're a $300 million fund, and we take 10% when we invest, which means you need to pitch us a pathway to becoming a $3 billion plus exit, right? That's just math. And that was very surprising to, the other companies in the room, is that, that's not necessarily what they're always hearing in the UK and Europe. There's certainly some funds that talk that way in the UK and Europe, but there's some funds that don't talk that way in the UK and Europe. Whereas in the US, it certainly, if you go to one of the big ecosystems like the Bay Area or like in New York, it's much more likely that you run into Series A investors, and most of them are going to be talking like that, or maybe not all, but a lot of them are going to be talking like that. And, some of the feedback that I've gotten on that topic from UK and European founders is like, well, if we go out certainly to some funds in the UK and Europe and make that kind of pitch, they're not going to view it as credible. Right. And that, that's a challenge. And it means that you got to calibrate appropriately as you go out to the United States and understand who is it that you're actually pitching to. And, are you aligned in terms of what you are trying to build, right? That if the company, really wants to go for the brass ring and is willing to forego possible exit opportunities before then, and take substantial risk for substantial upside, then go pitch that and find the investors in the U.S. that want to do that. But if the company's thinking, actually, when push comes to shove, I actually kind of want to build a much more stable structure, and I'm fine accepting a smaller outcome. Well, understand that the people that you might be pitching to in the U.S., you might not be aligned with that. And I think that comes as a bit of a surprise to some founding teams as they go out to the U.S., that they may be building a more than perfectly respectable, an outstanding business. But to a lot of funds in the U.S., it may still be too small because they're looking for the once in a generation businesses. Right.
That's fascinating, and that's something that we've talked about before, which is, focusing on the opportunity. That really is, it's innovation, it's opportunity, it's the market, it's the TAM, as you say. Which brings me on to kind of the next question, which is culturally. How do founders adapt to orientate themselves around that? Yes, of course, there's the TAM slide, that you can really understand the opportunity and talk to that. But culturally, what should they embody? How should they be embracing that and taking that to this set of investors?
Well, first, they need to take a good look in the mirror, figuratively and literally, and say, what do I really want here? Right? What is the right fuel for the engine? To belabor the obvious, the fuel being the money and the engine being the company, right? If the management team is thinking, I don't want to take that level of risk, no problem, right? But then just, you need to orient your pitch and your target investors accordingly. But one of the things I always say is that, look, there's ultimately no barrier to becoming American. Right. And other than kind of two things, right, which is moving to America and then kind of, buying into the American mindset. And that, that America in many respects has always been, kind of a state of mind and a set of principles, rather than, like an ethnicity, so to speak. Right. It's almost like a way of viewing the world. And, anybody can come to the U.S. if they're so inclined and pick up on that mentality and say, I'm going to go for it, right? It's the whole idea of how the U.S. was built in the first place, right? People who leaving Europe, which was a perfectly great continent to build a life, right? And saying, no, you know what? I'm going to go to the other side of the world. I'm going to take that boat trip for 2 months and might not make it. But if I do, then I'm going to get there. And I'm not even going to stay put. I'm going to then keep pushing across the United States, manifest destiny. we're going to reach the other side, right? It's that sort of like that culture of constantly pushing and striving. And there's nothing stopping anybody from buying into that and embracing that other than, is that really what you want? And I'm not here to say that it is or isn't or should or shouldn't be, but recognizing that that's the culture. And what you're doing when you go out to pitch to classic American venture, you're embodying that. You're saying, listen, I'm out there willing to take lots of risks, right? And I've got two goals, mission and money. Change the world, whatever it means in the context of my business and money. While doing it, we're going to make as much money as possible for everyone around us. And if that is what you want to do, there are people in the US that will back those risks. But the question that you got to ask before you go do that is that really what you want to do?
Yeah. No, I love that. And we spent hours together, right? And that's the first time I think you've ever said, like, America is a state of mind. And that really kind of, resonated with me, because I think that's what it is. I think people get very kind of deterred by the travel, going into a new environment, new culture, and understanding it. But at the very core of it, and I fully agree with you, it's a state of mind. It's a state of mind. Can you turn up? Can you, adjust and align and present, what is required? That is a state of mind. That is a state of mind. So, yeah, I totally agree with you. Thanks for the clarity on that.
And it does require, for the most part, certainly at the earlier stage, more of a single-minded focus on that market, right? Because the American market is so competitive and so big, right? That, one of the reasons that the rounds are bigger in the United States is because it takes more money to win the market than it does in most other places. And, and I think that's where, a lot of the times I get questions from founders like, why are US VCs so focused on us, like moving to the United States, becoming a Delaware company, things like that? Well, because it's so hard, to compete and win in the United States that you want to tick as many boxes as possible to not make it any harder than it already is.
Yeah, you need to de-risk it on every kind of every element that is in your control, right?
Because there's so many out of your control that creates
exactly
risks. Yes,
exactly.
Dan, thanks for sharing these insights. I just think it's so critical for founders who are trying to raise in 2026 to understand all these topics really well and help prepare them for the process. As we wrap up, as we're looking forward to 2026, knowing that's kind of the trends that are behind us from last year, what advice do you have for founders? Kind of macro, like looking forward to 2026, founders planning to raise this year from U.S. investors at the A round. What's your advice to them as a parting message?
Yeah, I would. I don't have a crystal ball, right? But what I will say is this: I've been doing this long enough since the late 1900s that there are always peaks and valleys, right? I think back to the .com boom and bust, and then then the run up in 2000, the mid 2000s, and then you look at the financial crisis toward the end of the decade, and then this sort of long, steady bull run, culminating in 2020 into 2021, but then a bit of a downturn again in the early 2020s, which is all leading to it never lasts forever, right? And that the history of venture capital, when you go back far enough, tends to be a lot of peaks and a lot of valleys. And again, I don't have a crystal ball, but things are actually pretty good right now, all things can considered. So I would say that there is no time like the present, because if history teaches us anything in a venture ecosystem, is that it's a little bit more volatile than other areas of the economy. And if you find yourself in a good position right now, whether it is to go out and raise or whether it's, for a new product offering or to do something, right, where you're going to be taking a little bit of risk and pushing the envelope. Again, without having a crystal ball, this is probably this is not a bad time right now. And you never know what's going to be around the next corner.
Great advice. Thanks for sharing your insights with us. We appreciate it as always. We look forward to having these discussions on an ongoing basis, trying to keep the founder community updated on current trends. Thanks again, and we'll see you next time.
Got it. Great to see you guys.
Thanks, Dan.